questions because Civitas has had a lot of attention over the last 5 years, and in particular over the last few months. So I'm very happy to address any of those questions. Just giving a brief overview, my background is from the social housing sector. Apologies, I've got a cold today, so it's good but we're not live because I'm not giving you the cold, but equally I'm a little bit hoarse. And I've run a number of housing organisations, and then I came to found Civitas with others back in 2016, where we launched the first listed real estate investment fund to invest in social housing in 2 fundraisers, and subsequently Civitas Investment Management has established 2 other funds, one with CK Asset Management and one with Schroders. So just turning to the next page, and one after that, please. Thanks. So just some key numbers. Just a few highlights. I mean, the most important thing about this strategy is the people, and I'll come to that shortly. But the listed REIT, the portfolio that we have here today, is 100% let on long-term leases. We deliberately have long-term leases because the average age of the people living in our properties is 32 years old, and their life expectancy is going to be well over 70. They have significant care needs, and they require a home for life. So long leases are really important for families, for local authorities, and for commissioners, and indeed for care providers. 1/3 of our portfolio is newly built, although we don't take development risk. We do take development risk with Schroders, but we buy on exit. And 2/3 of the portfolio are properties that you might live in yourself and in a normal street in a community, because obviously the important thing is that people are living as close to family and friends as possible in a normal home, fully bespoke and converted, but on the outside is completely normal and safe and secure home for life. We work with 118 care providers, 16 approved providers who provide the housing management service, and you can see there that we house around 4,300 people. Totally across the Civitas portfolio, we now house approaching 8,000 people, all with a significant care need. So if you could turn to the next page, please. This is the cumulative returns since IPO, including dividends, and you will have seen recently that we announced our now forecast, and we do have our interim results coming up quite soon. But you can see the total returns there from 16 to 21. The idea of this fund is it's long-term, safe, secure, paying out income to long-term investors who want to invest their money for a long time, offered to match pension payouts and promises to other investors, and obviously people who are interested in a strong ethical and social outcome. More of that later. The next slide, please. And the total invested and the IFRS valuation, you can see that over the first few years of the fund grew very substantially. We had around 350 million at IPO to invest. 18 months later, we did a C share. We raised another 300 million. We've raised nearly 300 million in debt from major lenders such as Lloyds, NatWest, Scottish Widows, and M&G, and our leverage rate is just under 35%, so it's a low risk leverage rate. We have a hard cap of 40% in terms of leverage. As you know, in a REIT, the hard cap is 50, but we imposed a 40% cap at IPO. And you can see the valuation now is approaching £1 billion. I can have the next slide, please. Sorry, can I move the slides on, or is it here? Okay. In terms of the SSH Market Updates, so what underpins all of this portfolio and all of this investment? Well, as you probably know, for the last 40 years, UK government of whatever political persuasion has strongly supported the idea that people shouldn't be living in remote institutions, or indeed with their adult parents, where they become adults themselves, where they have a significant lifelong learning disability, mental health issue, or other care need, and these are people of working age. And in spite of that commitment by government 40 years ago, and enshrined in the Care Act in 2014, there are still many thousands of people still living in hospital today as we speak. MENCAP, the independent learning disability charity, have estimated, as you can see on this slide here, that in spite of Winterbourne View, which happened over 10 years ago, which you may be familiar with, was a shocking case of mistreatment. Obviously, many hospitals have very good treatments, but the principle being that a large-scale institution is not appropriate for people with long-term care needs, and why should it be? But in spite of Winterbourne View being a further wake-up call for everyone, there are still at least several thousand people stuck in hospital, and unfortunately, when a young person goes into hospital with a condition such as learning disability or autism, it takes on average 5.5 years for them to actually be discharged. Now, clearly, that's grievous for them in terms of their life and their family's life, because they're often in remote institutions, but it's also extremely expensive for the taxpayer. So the average cost, MENCAP estimates, of housing someone in a hospital is over £3,000 a week. And this is because the level of care that's required is higher where people are in an institution, because they need care from the institution as well as care for themselves, because the setting's inappropriate. So typically, when someone steps down into community housing, that average figure falls to around £1,500 a week. Turn to the next page, please. Critically in our portfolio, beyond housing people, which is obviously its primary purpose, and making sure the properties are outstanding, and we do a high level of due diligence within our team at the start of acquisition, is also providing additional social impact to our tenants, who are essentially the housing associations, the approved providers. So we've recently signed a national scheme with E.ON, who you probably know are the largest provider of green energy in the UK. And what we're doing is greening our portfolio. Here are some typical schemes here that we're working on. And this is of no cost to our tenants, even though our long leases obviously place the obligation upon them to maintain the properties. But our view is that decarbonisation needs to be our responsibility as a responsible landlord and a good citizen. If you turn to the next page, please. We've only just started this. In fact, the first phase is 55 properties. What that will mean is that all of the Civitas properties meet EPC, a minimum standard of C, but we are working on looking ahead on the programme to bring properties up to a higher level. We do have a number of A's and B's already. Obviously, they tend to be the newer buildings. The critical thing here as well is, as we're all familiar with, residential plays an enormous part in contributing to carbon emissions, but the reduction of carbon there's still innovative technology to come. Some of it in prototype form, some of it we're piloting, and some of it we need to access government grants, as we have with E.ON in this case. So, for example, all of the properties that we're working on here, the insulation is being paid for by government grants. And obviously that's important for investors to make sure that whilst the fund is investing in decarbonisation, it's not placing an excessive burden on investors. You turn to the next page, please. Typically, I'm sure everyone here is familiar with the typical things that you can do to a property to obviously ensure that decarbonisation is achieved. We obviously set some of these out here. In some cases, we have very large buildings. That's unusual, but it's where we have state-of-the-art facilities, such as our facilities in Wales, where that's providing very, very high acuity in a semi-medical setting, but not a hospital setting. And there, of course, the innovations that you can do go much wider in terms of, you can look at obviously community heating and other measures to work with the national grid to actually produce green energy. If you can turn to the next page, please. This is the implementation phase. If you can, and obviously we show what we're measuring strictly here is the numbers. It's all about numbers. We have to be able to demonstrate the actual level of carbon that's been reduced is real. You can turn to the next page, please. So social impact, which is obviously the main theme of this seminar. So how do we measure our own social impact? I mean, clearly within every transaction, we've done 130 transactions. We have very strict criteria about where buildings are, the quality of the building, they're independently surveyed. We have independent rent testing to make sure the rents are appropriate. We make sure that the valuations are obviously independent, and we talk to all of the counterparties, the commissioners, the local authority, sometimes even the families where they're pre-nominated, but also the care provider and the housing association before we will purchase any single building. But we also, from the start of launching Civitas, wanted to have independent verification of what we are doing. So we work with the Good Economy, who are obviously an independent leader in measuring ESG and social impact in the social housing sector. And they've now produced 6 reports, all of them available obviously on our website. What those reports are looking at is, how do we conduct ourselves? How are our transactions done? What do our counterparties think of what we're doing right across the board? So they speak to residents, they speak to staff, they speak to local authorities, they speak to other counterparties that we work with. And obviously it's not the intention in the reports, and hopefully if you do get a chance to read the report, you'll see that this is true. It's not the intention that the report is a PR report. The intention is it gives where there's been good practice and where things could be better. As people will be familiar with, a key part of this strategy is making sure that we do save the taxpayer money. And that's been verified on the next slide by the social profit calculator, who have attributed direct cost savings to the investments that we've made. Now, obviously the direct cost savings are person A, Neil, moves out of the hospital, moves into property B. The cost of housing Neil was X, the costs are now Y, and those are actually real numbers and verified. They then attribute, according to government metrics, Red Book metrics around social impact, a social value, which obviously there you can see portfolio saving around £75 million a year in terms of savings to the public purse, 127 million in terms of social value. Clearly the social value figure is more subjective. It does include measures like travel costs, but also it does attribute costs and savings to well-being. So if families feel better in terms of the fact that their adult child now lives closer, that has an attributed value. But obviously the metrics are all available for exploration. You can turn to the next page, please. We've also recently, I know the speakers after me are experts in this area, we've also addressed homelessness recently. This is not a core part of our strategy, but as people are aware, during the pandemic, it became an emergency, the Everyone In campaign, to move anyone who was basically living on the streets immediately into temporary accommodation. Now, as you will know, most people, it was a very successful campaign, and local authorities did a great job. However, the majority of people moved into temporary accommodation. We provided 2 buildings here temporarily, and they're now being used permanently for homeless accommodation. We call this advanced homelessness because it isn't simply housing people, it's providing wraparound care to enable people to address whatever issues they had that they may have developed through being homeless or before being homeless, to allow them to start playing a fuller role in society. And we've been pleased to partner with Islington Council, with Barnet Council on that strategy. We will do some more of these schemes, but as I say, it will be a de minimis part of our portfolio. I think we're nearly at the end. We can just turn to, so here's obviously a selection of pictures of some of our properties. You can see the variation in styles and size, depending on whether people need to live right in the heart of the community or in a more secure remote location. So I'm happy to take any questions or comments now. Thank you very much for listening. Brilliant,
thank you very much, Paul. Yeah, we do have some questions coming in now. So just, you mentioned the E.ON partnership in your presentation. One of our questions is, will that be expanded across the portfolio, and what will the cost be?
Well, yeah, the plan is that it will be expanded across the portfolio, subject to successful delivery. Obviously, one of the reasons why we selected E.ON, and in truth they chose to work with us, is that we're obviously both significant sized portfolios of institutions. Our counterparties tend to be small housing associations who wouldn't individually be able to negotiate a contract like that. It's 55 properties. I think that's a pretty good pilot, several hundred bed spaces. And the cost of it, as I was implying earlier, will be partly, our intention is that each year the fund will pay for some of this, but it will be a de minimis amount. We're talking several million rather than, tens of millions, but also that we will access partnership resources because, as I was saying in the first phase, the installation is paid for by the government, and that's perfectly legitimate. The government grants available. If you look across the social housing sector, of which we're a tiny part, of course, it's estimated that the bill for decarbonisation, is multi-billions of pounds, and everyone knows that will require some subsidy and government support, and we're part of that too. But we believe we can achieve, a very good rating with E.ON across the piece for a reasonable investment over a reasonable period of time, essentially 8 to 10 years.
Sure, thank you. What is the average EPC rating on the portfolio, and how much do you think it will cost to improve it?
Well, I don't, as I sit here today, it would be wrong of me to give a number in terms of investment, because obviously different properties have different, I've seen ranging between, only £5,000 to bring a property up to say £20,000. But as I say, some of that can be contributed from grants. Our average rating at the moment is C.
Sure. And will the cost of making properties more energy efficient be reflected in valuations?
That's a very good question. Currently, we haven't had any independent valuation of any properties that have had these works done because the work's really just started. I think philosophically, it makes sense that a property that has a less carbon emissions than the same property next door, obviously we don't quite have that metric, would have an additional value. So we would certainly, our valuations are independent, so we can't influence them, but certainly that's what we'd be seeking to point out to the value.
So one of our attendees noticed the increased dividend announcement, which is very welcome, but how will that be covered?
It's covered by earnings. Yeah.
How much has been spent on buying back shares, and how much more do you anticipate doing?
Okay, I can't talk about how much more might or might not be bought back, because obviously that's a board decision. Obviously we're buying back shares because we have had some short selling on the stock, and obviously the stock is now performing below its net asset value. As of a few days ago, I think we bought back about 400,000 of shares. I'd need to check on that to get the absolute number. Obviously, I'm not privy to those decisions because we're in a closed period. But the board will, obviously consider buybacks where it feels it's of good value for the fund. It's really good value at the moment, obviously, with our current share price.
Thank you. Do you have plans to buy more properties, and is this restricted by supply or team resources?
Well, we are buying properties every day. As I mentioned earlier, we have 3 strategies running. At the moment, this listed vehicle is almost, basically requires more equity. We've obviously not done an equity raise recently, largely because of COVID, and now because obviously of the action on our stock. But obviously we'd like to grow the company. But as I said, we are working with other investors to invest. And there's huge demand, absolutely exceptionally high demand.
Sure. Can the lease-based model ultimately be prohibited by the regulator or government?
Well, we don't think so. And I mean, we work very, very closely with the regulator. I'm not regulated, Civitas is not regulated. Leases, the history of leases in the social housing sector goes back many decades. There were a few housing associations that ended up in instruments that were frankly not helpful for those organisations, not the type of organisations we work with. Where the regulator is coming from, and I can't speak for them, but this is my understanding of their position, is that they absolutely see a high demand for this form of housing, and they've said that publicly. They recognise there's no government money to pay for this. The government chooses to invest its money into welfare, care, housing benefits, and those costs are very high. If they wanted to buy all these properties themselves across the country, that would be an egregiously high number. And it's been, this lease-based model has existed for several decades without any interruption. There's been no interruption to rents. What there has been is a few housing associations which needed to improve. A regulator that, because they saw that some of those housing associations needed to improve, has expressed concerns about the commitment of a long-term lease. Now, they haven't expressed concern about the length of the lease because they know that the commitments in the lease are matching very vulnerable people, as I said earlier, who are very young. So rightly so, they're saying to housing associations, how do you assess the risk of taking on these obligations? Now, good housing associations work with us to assess rent levels, making sure that they're obviously the right level, that the property is commissioned by the local authority, that the care provider is in support of the scheme, and that somebody's there to move in and obviously to live there for as long as they need to. And we believe that that's a very strong model, but we continue to talk to the regulator about how they can become more comfortable with it. To directly answer the last part of the question, it is not our belief that we have contracts and leases in place. So in an event, which I don't think will ever happen, but a government said we don't want this model anymore, our current, obviously, obligations and contracts would remain in place.
Sure, just following up on that, what is the regulator unhappy with regarding the model, and what powers do they have to change things?
So the regulator of social housing is mainly responsible for overseeing current housing organisations, and Homes England, who doesn't regulate housing associations but invests on behalf of the government, is responsible for obviously bringing forward more social housing. They're responsible for collaborating together, and all housing associations there's an expectation on all housing associations that they don't have to do it because they're private companies, even though they're registered with the RSH, but that they try and bring forward more social housing. The regulator does not have the power to direct a housing association's activities unless a housing association has done something. For example, if a housing association a creditor starts trying to wind up a housing association because of outstanding debts. The regulator then does have powers to place people on the board, but it doesn't have powers to break contracts, to break leases, to set rents, or to break any of the agreements that are in place. Obviously, it's influential, and rightly so. We want housing associations to work well with the regulator. The regulator's interests are aligned with ours, which are we want more quality social housing that's well managed and delivered. But if the question is, can they shut this model down? No, we don't believe that they can.
So I'm sure this is the question that a lot of us were anticipating. What is the latest with the short seller and its attacks on the company?
Well, I don't know what the latest is because in terms of the day-to-day activities of that short seller, I have no internal knowledge of what their actions are and what their proposed actions are. Obviously, the sequence of events is that they took a short position, which they then disclosed. A number of accusations were made, but not formalised into any reports. When that was formalised and sent to the board of the PLC, the board of the PLC took independent advice and responded back in a 37-page letter. If anyone's got the time to read all of it, it's on our website. It's all set out there. Obviously, the reason it took several weeks to provide that response is that we wanted to provide one response because there were a number of allegations in the short sellers report. And we wanted to make sure that not only did we give our position, our clear position, but it was independently verified. So we had it verified by the PLC's lawyers. Obviously, we completely accept as a public fund that we're in the public eye at all times, that we have to be held to account for what we do. If we make mistakes, we need to own up to them. And, we think we've done a really good job in the last 5 years providing lots of great homes, but also sustainable returns for investors. There's a particular issue raised around disclosure of OpCo-PropCo transactions, which we had advised we didn't need to disclose, and we have now disclosed. And that's the key area that's, I guess, the key area of learning. On the rest of it, of course, a lot of it is around challenging the model and asking whether our income is secure. And I hope we've demonstrated that it's very secure. It's only very secure because of the actions that we've taken to buy the right buildings in the right place and work with the right people.
Brilliant, thank you very much. As I asked our previous guest, what were your key takeaways from COP26?
Well, residential is absolutely critical to this story, and we have been thinking about this for a while. We want to make sure that the portfolio is decarbonised and that we contribute to that. So that was the key takeaway for me, really.
Thank you.
All of that.
We've all been feeling the pinch of soaring energy prices recently. How, if at all, does that impact the portfolio?
Well, in the most cases, energy is managed by the care provider, and they've often got long-term contracts because often they are, it will vary from building to building. We have 120 care providers. In some cases, care providers will be quite small, but in other cases, they'll be quite large, so they might have bulk contracts. So I'm not aware, as I sit here today, that it's turned into a major problem, but it's a good question and one I'll be exploring with partners. Sure.
What are you most concerned about going into 2022?
Well, it's all about, through this pandemic, this portfolio and other portfolios like it have provided outstanding care to people, and we've had very, fortunately, very, very low levels of COVID. It was a concern at the start because obviously this is care. These are vulnerable people. They do tend to be younger, but there was the risk of obviously contamination, people moving from building to building. Because these schemes are very much set up on their own with independent support, it isn't that type of care. But obviously our key concern is the health and safety of people that live in our buildings. So it would be, another resurgence in the pandemic. I'm not saying that's not my prediction, it'll happen, but that's a concern. Yeah.
On that note, and I'm surprised it's taken this long to talk about COVID actually today.
It makes a change, doesn't it?
Yeah, the buzzword definitely of the last 18 months. But how did the pandemic impact the portfolio, and how did you navigate through that?
Well, in our portfolio, we're not responsible for the management or the care, but we spend a lot of time out talking to people, going to buildings, doing asset management. I personally visit properties a lot. The immediate key change was not doing that, but we instigated weekly calls with all our key counterparties because we wanted to stay in touch, wanted to find out what was going on. The key worries at the start of the pandemic were PPE, because as you know, that was in huge demand. Funnily enough, a lot of our care providers had PPE stored, but it was still, a worry. Nowhere near as bad as in elderly care, but that was a worry. The other issue was staff welfare, because in typically in elderly care, you might have, depends on the type, but you might have one or two carers looking after 30 people, and then more carers in different parts of the building and potentially moving from building to building. In these settings, often the care provider have worked there for years, they're working with particular individuals. But what we did have was some heroic work from care providers, individuals who isolated from their families so that they could maintain a level of care. During the middle of the pandemic, the issue became one that we all faced, which was one of the purposes of these properties and these homes is for people to have their independence with support. So being locked down and having that independence restrained, not restrained is the wrong word, but constricted, caused concern for people. We did partner with some care providers around providing, iPads for people, providing other activities. But that was a challenge too. But it's not been easy for any of us, has it? I mean, on a financial basis, we've collected all our rents, we have no issues around that. On a human basis, most importantly, very few people have suffered from the pandemic, but everyone that's been engaged in it has worked incredibly hard.
Thank you. Where do you get your investment ideas from, and how long is the process from introduction or discovery to investment?
I mean, in terms of our team, we have about 35 people in the SIM team, and we have people from different backgrounds. So, as I mentioned earlier, I'm from social housing, we have people from care, we have people from education, we have people from real estate. So some of that's from our own knowledge. Obviously, through our partners, talking to care providers a lot. For example, that's where it became clear to us that investing in schools, not within this strategy, but within another strategy, schools for people with special care needs was going to be an objective that we want to look at, because actually at the moment we provide housing from basically 18 years upwards. But of course a lot of young people are coming through the system who, part of the reason why there's growth in demand here is good news, which is that more and more children are surviving traumatic birth over the last 30 years, growing up into adults, and the adults they're growing into will live longer. But obviously they also need support as children. So we're looking at that as an investment and an asset class. partly about liaising with people like yourself and other people in the industry, in different parts of the industry. You know, we're very situated both in the social housing sector and in the healthcare sector, because the two overlap enormously. They don't overlap very cogently in terms of delivery, but they overlap enormously in terms of need, because obviously what we're dealing with here is people who have health needs and also have housing needs. So what we're trying to do is bring those two things together, and that's where we got a lot of investment ideas from as well.
Thank you. Do you make property disposals in the portfolio, and if so, assuming these are empty properties?
We don't. I mean, the idea of this fund is to be an evergreen fund. I'm not saying we'll never dispose of property. From time to time, we will find a property that needs reorientating. In fact, Golders Green earlier that I showed you on the screen was providing care for a local authority, and we've changed that. Thank you. It's on the right. We've changed that to homelessness because it's more appropriate. It's quite a large building. It's not really appropriate for learning disabilities with 42 rooms, but it is appropriate for because it's in cluster and cause for homelessness. So we haven't sold a building to date. If we found a building that really didn't work, obviously that would be a strategy. Voids are interesting in this sector, so that they're the other way round to general needs social housing. So you will have a higher level of initial voids, and the reason for that is because when a new building comes online, clearly it's totally inappropriate to move in, say, 10 people overnight. In fact, there was a programme a few years ago called Home Free on Channel 4, still available, that plotted and followed a number of young people moving for the first time into a specially supported living home. In fact, one of the homes was ours. We didn't know this before they filmed. And what it shows, it takes about 6 months for the buildings to fill up. In that time, the cost of the void will either be met by the care provider, because the care provider wants to make sure that they've got the total building available to move in all the people they've got nominated, and sometimes by the local authority. The key thing is the cost not being exposed to the housing association and not exposed to us, because we're an income producing fund from day one of acquisition. However, once the property is full, the likelihood of a void falls very significantly. So in general needs social housing, the average occupancy is 9 years. In this sector, it's hard to say what the average is yet, because obviously it's been going for less of a time. But what we're seeing is, as I said, average age 32, life expectancy approaching 70. So the anticipation is that people will be in the building for many decades. And all of the evidence suggests, and one of the reasons to invest in homes like this, is all the evidence suggests that moving people with a learning disability is very distressing for them and costly and unsatisfactory. So you would expect there to be very low voids and voids declining over time.
Thank you. Just on the homelessness property portion of the portfolio, how big is it at the moment, and how big do you think it could get to?
Well, the proportion of the portfolio, so it's about 200 bed spaces out of 4,200, whatever percentage that is, de minimis, obviously. It will never be a significant part, because we don't want to do homelessness, and there are very good other funds that do homelessness in a way that is much wider ranging than us. We want to do high acuity homelessness, if that's the right term. So the people that are living in Golders Green, we're releasing a video soon actually of some of their stories, and a book of 50 residents across our portfolio and their experiences. So I think what you see when you plot their story is that they've been in emergency temporary accommodation, that they're now moving into this accommodation where they may reside for up to 2 years. They're getting employment support, training, other medical attention, perhaps psychological help, and then the intention is they move into a permanent home. So that's the type of homelessness we want to do, because it fits very well with the rest of our accommodation, which is around high acuity, high need, longevity of stay, and longevity of income.
Thank you. Apart from serving notices on housing associations, are there any other measures the regulator could take?
Well, as I was saying earlier, it's very clear in the guidance actually that they have authority to. So how is a housing association ultimately managed? It's managed by an independent board of directors. Housing associations are they're not owned by the regulator. They're not owned by the state. They're private companies. Some of them have registered charity status. Some of them are community interest companies. The authority that the regulator does have is they can appoint a general manager who essentially replaces a chief executive if the chief executive is regarded as not up to standard. That's a temporary measure. And they can place nominees on the board to help the organisation. So that the intention of that is to help an organisation to improve. Now, there have been a few cases recently where, because all of this accommodation is based on exempt rents, and exempt rents are important because they are exempt for a reason. They're not exempted by us or exempted by the state. And the reason that they're exempted is because they're providing accommodation for people with significant care needs and managed by a suitable social housing provider. And there's various other categories under that. And there has been some abuse of exempt rents in the sector, not within any of the housing associations that we're working with, but there have been portfolios where the amount of care provided is very, very low. And people argue that isn't an exempt rent. Now, an exempt rent is regarded as 3 hours a week or more of care. The average amount of care in our buildings is 43 hours a week. So you can see it's a very different type of accommodation that we're talking about here. But the regulator, ultimately, it could deregister a housing association, but it would have to prove that that organisation was not providing social housing. And it's a very rare event. In extremis, because obviously where this question is coming from is concern about how housing associations manage their risks. So in extremis, if a housing association gets into real difficulties, how we mitigate this is we have at least 2 other providers in the same area that can manage the same properties. The key way to think about this is that if an office building is occupied or a retail building is occupied by a shop or a company that goes bust, the landlord has to find a new tenant. We're not in that position because there's somebody living in a property who's very vulnerable and is receiving income from the state. The position that we're in is we have to make sure that the property continues to be managed well. And so that's why we have a range of counterparties to work with. It's important to note as well that it isn't only registered housing associations that manage properties like this. There are CICs, community benefit societies, there's charities, there's local authorities, and we can also have leases with all of those counterparties as well.
Lovely, thank you. I'm afraid that's all we have time for now. Thank you very much for your participation in today's event, giving us lots of food for thought there, and you've reminded me that I need to insulate my loft.